Two traders, same strategy, same market, same exact signals. One of them grew his account for 2 straight years. The other one blew up 3 separate accounts in that same time. Same strategy, completely different outcomes. So what was the real difference between them? It had nothing to do with the strategy. It never does. And once you understand what actually separated them, you will never waste another dollar chasing a better strategy again. In this video, I am going to show you exactly why discipline beats strategy every single time. No charts, no indicators, no complicated systems, just 3 powerful real-life trading scenarios that prove why your daily habits, your consistency, and your self-control matter more than any strategy you could ever buy, learn, or copy from someone else. Most traders spend years figuring this out the hard way, losing money, blowing accounts, starting over. You are going to understand it right now. Let's go. Let me tell you about a trader named Daniel. Daniel had a genuinely sound, solid strategy. He had spent months building it, testing it, and refining it. He knew exactly what a good trade setup looked like. He had clear entry conditions. He had a defined stop loss on every trade. He had a profit target written before every entry. On paper, his strategy worked well. His backtesting showed consistent results across 2 years of historical market data. His win rate sat around 58%. His risk to reward was 1 to 2 on every trade. Any serious trader would be happy with those numbers going in. So Daniel finally started trading live. The first 2 weeks went smoothly. He followed his rules carefully. He took only the setups that matched his criteria. He managed every trade according to his plan. He ended both weeks in profit and felt genuinely confident about what he had built. Then week 3 arrived and everything changed. Daniel entered a trade that matched his setup perfectly. The trade moved in his direction almost immediately. Everything looked great. Then the market pulled back a little. His trade was still well above his stop-loss level. There was nothing technically wrong yet. But Daniel started feeling nervous. Something about this pullback felt different to him. His gut was telling him this one might be different. He could not explain it logically, but the feeling was real and it was loud. So Daniel moved his stop-loss. He pushed it further away from the current price. He told himself he was giving the trade more room. He called it a tactical adjustment. An intelligent response to changing conditions. The market kept pulling back. It hit the level of his original stop-loss. Then it kept going. Eventually, it hit his new wider stop-loss, and the trade closed for a loss that was nearly 3 times larger than what he had originally planned. That single trade erased the gains from both of his previous winning weeks combined. Here is the brutal part. His original stop-loss was placed correctly. If he had left it alone, the trade would have stopped him out for a small, manageable loss. And then the market reversed and moved strongly in his original direction. He would have simply re-entered and captured the full move. But Daniel's emotional adjustment turned a small planned loss into a large, devastating one. Why do traders do this? Why do they move stop losses? Why do they break rules they know exist for a reason? Why do they override systems they built when they were calm and thinking clearly? It comes down to 2 powerful psychological forces working together: loss aversion and ego protection. The human brain absolutely hates being wrong. Taking a planned loss feels like being wrong, and the brain will go to extraordinary lengths to delay that feeling, including abandoning the very risk management rules that are there to protect the account. When Daniel moved his stop-loss, he was not making a smart tactical decision. He was making a purely emotional one. He was trying to avoid the discomfort of being stopped out. He was protecting his ego in that exact moment, at the direct cost of his trading account. This pattern shows up constantly in trading. Traders move stop losses. They hold losing trades far too long. They exit winning trades too early before the target is reached. Every single one of these behaviors comes from the same root cause: the brain trying to avoid the feeling of being wrong. or trying to lock in the feeling of being right before the market can take it away. No strategy in the world can fix this. You can have the best strategy ever created, and it will not help you if you abandon the rules the moment they feel inconvenient. So, what actually fixes this problem? The fix is a pre-trade commitment ritual, a simple but powerful habit you do before placing every single trade. Before you enter any trade, take 30 seconds and write down three things: your exact entry price, your exact stop loss level, your exact profit target. Then write one sentence underneath: I will not move my stop loss for any reason once this trade is live. It sounds simple. It might even sound unnecessary. But here is why it works on a psychological level. When your stop loss is written down as a formal commitment before the trade begins, breaking that rule later feels like breaking a real promise, not just changing your mind in the heat of the moment. That small shift in how your brain frames the situation makes an enormous difference when emotions are running high. Daniel adopted this practice. He kept a small notebook right beside his keyboard. Every single trade, before entering, he wrote it all down: entry, stop, target, commitment statement. The first few times his stop was hit after doing this, it still hurt. He still felt the sting of the loss, but he did not move it. And over the following weeks, his results began to accurately reflect what his strategy was actually capable of producing, instead of what his undisciplined emotional reactions were capable of destroying. The strategy was never broken. The discipline was broken. And here is the good news: discipline is the easier thing to fix. Ask yourself honestly right now: how many times in the last month did you move a stop loss after a trade was already running? That number tells you more about your real trading problem than your win rate ever could. Now let me tell you about a trader named Chris. Chris was genuinely smart. He understood markets well. He could read a chart quickly and identify setups without much effort. He had good instincts about price behavior. On pure intelligence, Chris was ahead of most traders who start out. But Chris had one deeply costly problem. He could not stay with a single strategy for more than a few weeks at a time. The cycle always looked the same. Chris would discover a strategy, feel excited about it, start trading it live, hit a rough patch of 2 or 3 losing trades, immediately decide the strategy was broken or not suited to current market conditions, then go searching for something new and better. Then he would find a new strategy, get excited again, trade it for 2 or 3 weeks, hit another rough patch, and begin the whole cycle over again. In 18 months of trading, Chris switched strategies 11 times, 11 different strategies, 18 months, and his account barely moved in any direction. Sometimes slightly up, sometimes slightly down, but mostly a slow grinding flat line, with a gradual downward drift from transaction costs and poor timing on entries and exits. Here is the part that should hit hard. At least 4 of the strategies Chris abandoned during that period were actually profitable over the long run. He just never stayed with any of them long enough to find out. He bailed during normal drawdown periods that every single strategy goes through, just before the recovery came. He left money on the table 11 times. Not because the strategies were bad, because his discipline was not strong enough to let them work. So why does this happen? Why do intelligent, motivated traders keep jumping from one strategy to another? The answer is a psychological pattern called the illusion of the perfect system. Human beings are hardwired to be pattern-seeking creatures. When something is not working, or appears to not be working in the short term, our brains push us urgently to find something better, something without the flaws we just experienced, something that does not have those losing trades in its recent history. But here is the fundamental truth about every trading strategy that has ever existed. Every single one of them has losing streaks. The best strategies in the world, run by the most sophisticated institutional trading firms with unlimited resources, still go through extended periods of drawdown, where they lose trade after trade after trade. That is not evidence that the strategy is broken. That is just probability playing out the way probability always does. Streaks of losses happen randomly even within a winning system. That is basic statistics. When Chris hit a losing streak on a strategy, his brain interpreted it as clear evidence that the strategy was broken and needed to be replaced. But a short-term losing streak is not evidence of a broken strategy. It is a completely normal part of every strategy's natural performance curve. The problem is that most traders never stay long enough to see the full curve. They exit during the drawdown, right before the recovery. They never collect enough data to make a real judgment, and then they start the cycle over with something new. So what is the actual solution here? Two things working together: a minimum commitment period and an honest evaluation method. First, when you choose a strategy, commit to it for a minimum of 3 full months before making any judgment about whether it works or not. Not 3 weeks, 3 full months, a minimum of 60 to 80 individual trades. That is the bare minimum sample size where you can begin to evaluate real performance versus random short-term variance. Anything below that sample size, and you are drawing conclusions from random noise. You are not evaluating strategy performance at all. Second, evaluate the strategy the right way. The wrong question is, did I make money this week? That is not a useful evaluation. The right questions are these: am I following the rules of the strategy exactly as they are defined? Are my losing trades valid setups that simply did not work out this time? Or am I taking trades that do not actually fit my criteria at all? If you are following the rules and still losing, give it more time and more trades. If you are breaking the rules and losing, that is not a strategy problem at all. That is a discipline problem wearing a strategy mask. Chris eventually made a commitment. He picked one strategy and promised himself 3 full months no matter what happened. He hit a brutal stretch in week 4, 5 consecutive losses. Under the old version of himself, he would have been gone within days, off searching for strategy number 12, but this time he stayed. He reviewed each losing trade carefully and confirmed he had followed his defined rules correctly on every one. He accepted that this was a normal statistical drawdown period, and that his job was simply to keep executing correctly and let the probabilities work out over time. By month 2.5, his strategy had fully recovered and pushed into new profit highs. He ended the 3 months with a meaningful gain, and far more importantly, with solid evidence that his strategy worked when he worked it with complete consistency. Strategy number 12 was never needed. Strategy number 7 just needed discipline. How many strategies have you abandoned that might have actually worked if you had simply stayed the course through a normal drawdown? Sit with that question, because the honest answer might be the most valuable insight you take away from this entire video. This third story is the most dangerous one I am going to tell you today, because it is about a trader who was winning, not losing. Winning, her name was Jessica. Jessica had been trading seriously for about 8 months. She had worked through the painful early mistakes. She had found a strategy that genuinely suited her trading style. She understood risk management and applied it consistently. She was building real momentum and seeing steady results week after week. Then she hit a winning streak. 6 winning trades in a row. Every setup worked. Every profit target was hit cleanly. Her account was growing faster than it ever had at any point before. And then, very quietly, without even fully recognizing it as it happened, Jessica started bending her rules. The first change was small and felt completely reasonable at the time. Her strategy called for risking 1% of her account per trade, but her last 6 trades had all won. So she bumped her risk up to 2%, just slightly more, just to take better advantage of the momentum she clearly had going. The second change was also subtle. Her entry rules required 3 specific conditions to be present before she would enter a trade. On one particular setup, Only two of the three conditions were clearly visible. She entered anyway. Her gut told her it was fine, and that trade won as well. The third change was that she started accepting slightly off criteria setups more and more regularly because her recent off criteria trades had worked out. Her brain was quietly gathering evidence that her instincts were sharper than her written rules, that she had developed a feel for the market that went beyond what was written in her trading plan. Over the following 3 weeks, Jessica gradually drifted from disciplined rule based trading into something that only vaguely resembled her strategy, while actually trading mostly on confidence and feel. Then the market shifted. Her winning run ended the way all winning runs eventually end. And because she had quietly inflated her risk per trade and loosened her entry criteria, the losses that followed were significantly larger than they should have been. 2 weeks of losses erased most of what 4 weeks of careful winning had built. Jessica was devastated, not just financially. The psychological damage was worse than any losing money she had experienced before, because she had genuinely believed she had finally arrived. She believed the discipline and strict rule following were training wheels she had now outgrown, that winning consistently meant she had earned the right to trust her gut over her plan. She had not earned that right. She had simply been on a winning streak, and a winning streak is not evidence of superior skill. It is probability, and probability does not care how confident you feel. The psychology behind what happened to Jessica is called the hot hand fallacy. This is the deeply human tendency to interpret a streak of success as proof of elevated skill that will continue indefinitely. Basketball fans believe a player who has hit 5 shots in a row is certain to hit the sixth. Traders believe a strategy on a winning run will keep winning because it has been winning recently. Sometimes it does keep winning, but the streak itself is not proof of that. Markets are probabilistic environments. Streaks happen randomly within any probability distribution. They do not predict future performance. And when you attach your discipline to a streak, when you loosen your rules because things have been going well, you are making a very costly mathematical and psychological mistake. What makes this pattern so dangerous is the timing. It does not hit beginners who are still learning. It hits traders who have already done serious work. Traders who have earned real results through real effort. Right at the moment when they feel safest is exactly when this trap springs shut. So what is the fix for this pattern? A consistent weekly post-trade review practice, not just after losing weeks. Especially after winning weeks, every single week, regardless of results. Sit down and honestly answer 3 questions. Did I follow my entry rules exactly as defined? Did I follow my risk rules without exception? Did I exit every trade according to my plan rather than my feelings? If the answer to any of those questions is no, even if that trade made money, that is a serious warning sign that needs immediate attention. Because a winning trade that broke your rules is teaching your brain the most dangerous possible lesson. That breaking rules is acceptable, that your instincts are better than your process. That lesson will cost you. It cost Jessica enormously. After she recovered both financially and emotionally, Jessica made the weekly review a non-negotiable part of her trading routine. Every Friday without exception. 3 questions, 30 minutes. Honest answers written in her journal. She caught herself beginning to drift from her rules twice in the following 6 months. Both times it was during periods when she was winning consistently. Both times the review caught it before real damage happened. She said something once that I want you to carry with you. She said, "Winning made me feel like I had finally arrived. But discipline is not a destination you reach and then relax. It is something you practice every single day, and you have to practice it hardest when everything is going well." The winning streak trap is real, and it comes for traders who have already done the hard work. Right at the moment, they believe they are finally safe from their own worst impulses. Do you review your winning trades with the same honest scrutiny you give your losing ones? Most traders do not. And that gap is exactly where the next breakdown quietly begins. Let us bring all three of these together now. Three traders. Three completely different situations. Three different ways that weak discipline destroyed what a solid strategy was working hard to build. Number one, Daniel had a strategy that worked, but he moved his stop loss the moment a trade made him emotionally uncomfortable. His ego could not accept being wrong. The fix was a simple pre-trade commitment ritual. Write the entry, the stop, and the target before placing the trade. Commit to it formally. Honor the version of yourself that made that decision when you were calm and clear-headed. Number two, Chris had multiple strategies that actually worked, but he abandoned every single one during completely normal drawdown periods, right before the recoveries arrived. The fix was a minimum 3-month commitment with an honest rule-based evaluation. Judge your strategy on whether you followed the rules correctly, not on whether you made money in the short term. Sample size matters. Statistics need time to play out. Number three, Jessica was genuinely winning, and that is precisely when her discipline broke down. Success made her feel like the rules no longer applied to her. The fix was a weekly post-trade review practice that kept her honest even during winning periods. Catch the drift early, before it becomes a disaster. Here is the one truth that runs through all three stories. The strategy was never the problem. Not once. Not for Daniel. Not for Chris. Not for Jessica. In every single case, the strategy was functional. In every case, the breakdown was in how the strategy was executed, not in the strategy itself. This is the insight that will save you years of expensive mistakes if you accept it now rather than later. Stop searching for a better strategy every time results go bad. Start looking honestly at your own behavior instead. Ask whether you actually followed your rules. Ask why you made the decisions you made. Ask what emotion was driving the decision you called a tactical choice. Discipline is not something you are born with or without. It is a practice. It is a system of habits and commitments you build deliberately over time. And it is completely learnable by anyone willing to be honest with themselves about what is actually happening. The best strategy in the world, executed without discipline, will lose money. A basic and simple strategy, executed with complete consistent discipline, will make money. That is not theory. That is what happens in real trading accounts every single day. If something in this video made you stop and look at your own trading differently, hit subscribe right now. Every single week I release content exactly like this. No hype, no fake account screenshots, no promises of easy money, just honest, real conversations about what actually determines whether a trader builds something lasting or keeps starting over. And next week, we are going even deeper into the mindset side of this game. We are talking about the one mental shift that separates traders who survive and grow long-term from the ones who stay stuck in the same painful loop for years. It is called trading like a business owner, not a gambler. And it will change how you think about every single decision you make at the charts. Sat to now. I will see you there.